it's much, much more advantageous to have multifamily versus single-family homes. That's just from my experience.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 45 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 23. Before I get into talking about my interview today, which I know you're going to enjoy, I want to talk a little bit about the class that I will be teaching this week for the RPOA, and it's called Advanced Financial Analysis. What I do in this class is I spend about 2.5 hours sharing with you how I run my numbers when I look at multi-unit and apartment investments. If you're interested in taking this class, it's going to be this Thursday evening, June 23rd, at the RPOA office right here in Grand Rapids. And you can go to rpoaonline.org to find out more information. That's rpoaonline.org. And there you'll find out how to sign up for the class. It starts at 6:30 in the evening. Seats do fill up fast, so I would recommend that you sign up online as soon as possible. I'm a big fan of podcasts, and one of the podcasts that I started listening to recently is by our guest today. Rod Khleif hosts a podcast. It's called Lifetime Cash Flow Through Real Estate Podcast. I highly recommend you check it out, and I especially recommend that you check it out this week because his guest is none other than myself. I interviewed him for this podcast and he interviewed me for his podcast. In both interviews, we both get the opportunity to talk about our interest and strategy when it comes to investing in multifamily and apartment communities. I think you're going to get a lot of great value out of both interviews. So let's just get into it. Here's my conversation with Rod Khleif. Rod, thanks so much for joining me today.
Oh, I'm thrilled to be here, Brian. Thank you so much for having me on the show.
You know, you have a fantastic podcast, and if anyone hasn't listened to it, it's called the Lifetime Cash Flow Through Real Estate. Why don't you start by telling me a little bit about your podcast, and then I want to get into your background.
I got into the podcast because of my background, and it's particularly the topic of the podcast. And my podcast is honed in on buying and managing and investing in multifamily real estate. And, you know, my background is I've owned over 2,000 single-family homes, and I've also owned apartment complexes. And I will tell you, and I'm telling you that as not to brag, but as a lesson as in what not to do, at least as it relates to the single-family homes. And that's so my podcast is all about the advantages of multifamily real estate, and from a whole bunch of factors from someone that has done single-family. You know, and I bring in experts in the multifamily space, from, you know, billionaires that own 35,000 units to, you know, people that have a few duplexes and everything in between, and you know, the advantages of going that route.
And let's talk about your background. Now, I know you are a Dutch immigrant.
That's correct. Yeah.
Being from West Michigan, you know, we're very close to Holland, and the Dutch culture is very strong here. So why don't you talk about that and how you went from there to investing in real estate?
Sure. It's kind of a funny story. Well, funny, and you know, it was really a meaningful beginning for me. I remember immigrating on a big ship. We came into the New York harbor. I have a vague memory. I was 6 years old, a vague memory of my mom crying when she saw the Statue of Liberty. Ellis Island was already gone, but it was, you know, along those lines, which was kind of cool when I look back on it. And I ended up in Denver, and my mom babysat for extra money. And she bought the house across the street when I was, 14, 15, something like that, for $33,000 or $32,000. Don't hold me to these numbers, but they're close. And then when I graduated, or was about to graduate, I found out the value of that house was $55,000. And although I did horrible in math in school, I was able to do that calculation, and I thought, you know what, I'm going to get rich in real estate. So I got my broker's license, and in Colorado, is at the time, I don't know if it's like that anymore, but you could actually go all the way to a broker's license. You know, it's easy to get a sales license, but to go all the way to a broker's license, typically you have to have experience, and you didn't then, and it was just all through schooling. So I got my broker's license right after I turned 18. I think I even made the paper because I was so young. But my first year, and then I thought I was going to get rich. I put a bus bench down at the end of our street with my picture on it and talked about my real estate company. And my first year I made 10 grand, which back in 1978 was, not bad for an 18-year-old kid. But second year I made 15 grand. Third year though, I made over 100,000. And this is kind of a lesson for your listeners that are wanting to get into something like real estate. And the difference between year 2 and 3 was my confidence. And my confidence came from my knowledge. So, if you're going to go out there and influence sellers or influence investors to invest in real estate with you, you need to know the subject matter. You need to understand it, and that'll equate to confidence. So, anyway, I fumbled around in real estate for a few years, and then I saw my broker making a lot of money by actually buying his own houses and flipping them. And, so I started buying houses, but I didn't want to flip them. I wanted to just buy and hold, and I ended up buying 500 houses in Denver. And then I ultimately ended up buying a couple hundred houses in Memphis, which was one of my seminars. I don't call my mistakes or my failures such. I call them seminars because they were always a learning experience, and that was a big one in Memphis. And then I ended up buying, 1,400 houses in Florida, and also some apartment complexes. And, I did the single family thing very, very hard. And in a buy and hold strategy, I'd buy them and I'd fix them up and I'd rent them out. And then 2008 happened. So, I could speak to that if you like.
Definitely. But before you do, you were buying a lot of houses.
Yes, I was.
How were you buying them? Were you buying them with cash, getting bank loans?
I can tell you, there was a time that I actually, when I was able to buy houses real cheap because the market had crashed in Denver, and I was able to buy houses in the 20s in areas where I'm not exaggerating right now when I tell you this, in areas that today houses are going for $800,000 or $900,000. These are old North Denver houses. But anyway, so I there was actually some I put on credit cards, 18% credit cards, because I was able to rent them well enough that I could cover them. But no, for the most part, I'd bring partners in, and I talked about confidence and your ability to influence, and I had the confidence, and I was able to influence people to invest with me, put up the money, and we'd split the deal 50-50. I bought hundreds of houses that way. And the other thing that happened back then, which was a real boon for investors, there were so many foreclosures at the time. This was, this would have been in the 80s, and don't hold me to the exact time in the 80s, but I think middle to late 80s. And you were able to buy houses from HUD. Investors could buy them 500 down, and then it finally went to 5% down. And even VA, you could buy them for 5% down. And, I was a real estate broker, so I got a commission, typically a 6% commission. So you do the math. I was able to, go in and with partners and buy properties that way, and bought a lot of them that way as well. So, and then, I did ultimately find some hard money lenders and was able to negotiate them down to a manageable long-term interest rate. And, I found someone that gave me 12% at first, and then she got me down to 10%. And, and I was able to hold the properties until I was able to refinance them, refinance the hard money out. So, I did a number of things like that.
It sounds like you bought thousands of properties starting in the 80s. So by the time you got to 2008,
you would think I knew what I was doing. Yeah.
Well,
okay.
No, it seems
you're
like
right.
Actually, it seems like you did know what you were doing.
Well, I did, but what I didn't factor, and let's talk about 2008.
Yeah,
First
please.
of all, Florida's taxes and insurance are very high. My properties are all along the coast, so you've got, flood insurance, you've got wind insurance. The taxes are, because Florida doesn't have a state income tax, they tax other things heavily, and for example, property taxes. So, it really, and I bought lower end properties. I was buying houses in the 20s, 30s, 40s, and then ultimately 50s. So that gives you an idea of the value of the properties. And in that sector, there's a high turnover. Excuse me. So because of the high turnover, let's say you're cash flowing on a house $200 a month. Well, when someone moves out, you're going to lose 2 or 3 months because you've got to fix it up. So you lose, say, $600 of your cash flow. Then let's say you have to put a couple $1,000s into painting it, maybe carpeting it, maybe fixing tile, fixing doors, other maintenance, things like that. Well, if you've put $2,000 into fixing it and you've lost $600 in rent, you've literally not broken even for 2 years. So because of the high turnover that I had, it was very difficult to break even, but I didn't care because the values were going up so much. And in my heart, I believed that Florida was recession proof. I figured 80 million people getting old and getting cold were going to impact the state of Florida. But I forgot one critical thing, and that is they have to sell their houses up north to buy down here. And really what I anticipated happening is starting to happen more and more now. But because of the model that I had to sell or refinance a house occasionally. And when the market contracted and nobody was lending money, and I put my whole portfolio out there at literally, I think, 32 cents on the dollar, and wow. I couldn't sell it. So, you know, and then what else happened was, you know, in 2006, my net worth went up $17 million from value of the appreciation in my properties. I'm like, oh, you know, and I did the math on how much that was per hour, and I was, you know, real cocky and thought I was so brilliant. But then it crashed so hard in 2008 that I was actually upside down. And I was at a great loan to value. I was, you know, in the 30 range of loan to value. For those of you who don't know what that is, for every $1,000, I only owed $300. Or let me use a better example. For every 100,000, I only owed 30,000. So I was at a great loan to value, but wow. I actually ended up going upside down. That's how hard it hit here, and you know, so I got hurt. It was a big seminar.
Yeah, and that happened, you know, you're not the only one. That happened to a lot of people.
Right. But what was interesting, I'm sorry, I forgot to add one thing, but what was interesting is my apartment complexes did just fine. Okay. They were cranking along, and even though we contracted and had some vacancy, they did just fine. And even the smaller ones, the plexes, you know, with most plexes, if you buy right, if one or two are empty, even a fourplex, you know, you can still break even. Well, the problem is with a house, if it's empty, you're 100% vacant. So anyway.
So let me see if I understand here, because it sounds like you were actually being very conservative if you had, you know, 70% equity in your houses. Yeah. Is that the case?
I was very conservative, and I'd owned this stuff a long time. I mean, I hadn't bought anything. Oh gosh, I want to say 04, 05. I hadn't bought anything since 04 or 05. And I was just going to, you know, coast. But the problem was I had to sell or refi. And then when I saw that I was literally upside down, you know, I had to let some stuff go, and it was ugly. It was an ugly time.
Wow.
But, you know, I'm back now. I mean, I'm fine. I've built some big things since then, but it was an ugly time. And that's why I started the podcast, because, you know, I got the lesson at that point that really single family, you know, yeah, you can make money in single family in a buy and hold strategy. If you're in the right markets, I think you could be okay. But why? It's you know, I can, in fact, if you'd like me to tell you, I can tell you why it makes much more sense to do multifamily. Besides economically, there are a lot of other reasons.
Absolutely. I mean, I much prefer multifamily and apartments as well. It sounds like, I mean, you did the single family thing, and
I did it in a big way.
You did it in a big way. You did it over a period of years, in what my mind seems like a very conservative way.
Right.
But you still got hit pretty hard.
Still got hit. And, you know, I had 800 houses when 08 happened. Okay. So, you know, I had houses in each direction, you know, 2 hours north, 2 hours south from me. And, you know, what I was alluding to as far as owning houses like that, unless you've got them very close together, and even then there are a lot of negatives, because, you know, from a maintenance standpoint, for example, let's start there. From a maintenance standpoint, every house is going to have different mechanical situations. It's going to have different HVAC manufacturers. It's going to have different appliances. It's going to have a different plumbing layout, different electrical layout. So from a maintenance standpoint, it's much more difficult than if you're in an apartment complex where everything is pretty much the same. Forget the logistics of having maintenance people drive around all over and the lost revenue from the travel time and the cost of that, but just the mechanics of parts, having to go and figure out what you need versus having it already stocked because you know what's in a complex and you know the types of valves you'll need and so on and so forth. Just logistically, it's much more expensive to do single family homes. And from a management standpoint as well, if you've got an empty house, you've got to drive to show it. If they're all in one center or, very close by, it's much, much easier from a management standpoint. So, on leasing standpoint.
Who is managing your houses?
I've always self-managed. I own the management company, and, I had people that worked for me that would handle the leasing and the maintenance supervision, and I handled it for a long time myself with an assistant. But I'm one thing I'm very good at is systems, and that's how I was able to buy the number of properties that I bought and manage them. But you get cocky and you get comfortable with a way of doing things, and that's what hit me in 2008 because I knew that I wanted to get into more multifamily real estate, and I just got lazy because I really thought I'd done it with the houses. But I would just caution your listeners that I've interviewed some real heavyweights on my podcast. Like I said, I interviewed a billionaire. In fact, that's my first interview. And then I interviewed a guy recently named Scott Shield that owns hundreds of millions of dollars worth of real estate and also teaches it. But they've both told me, and other people have told me as well, that there's a correction coming. And it's going to be a pullback. And they both think it's not going to be as bad as '08, but it's going to be bad enough where the banks could tighten up again. And I would tell your listeners, if they're doing single family, for example, maybe thinking about flipping, I would not do houses that are high value that you couldn't rent in case the market contracts. Let's say you can't sell because nobody can get financing for a while. You want to be in a situation where you've got a property that you can rent. So, go in with both eyes open as you're investing and just realize that, there's likely to be a contraction in the next couple of years. So.
And in your opinion and from your experience, you think multifamily much better insures you from this kind of downturn, huh?
No question. And again, it just ties into the fact that if you buy right, and there are still deals out there. There's a lot of money looking for deals, but there's still deals. I've got deals that I'm looking at right now, and that sound fantastic. $15,000 a door. And I got a deal in North Carolina, and those are unbelievable pricing, and so they're out there. But you've got to realize that in a multifamily situation, you can typically have a number of your units vacant and still be able to pay the bills, and so it's a safer way to go through a contraction. And of course, although it's been 7 years, I'm still a lot more cautious than I was back then, and because of what happened. And so, I look at, I listen when people say that, and I'm not a doomsayer. I'm out there looking for deals right now, but I would not, want to get into anything that had a long development cycle, for example, or anything that I couldn't step back into leasing if I was doing some buying and selling, that I couldn't fall back to a plan B if the market contracted.
Explain that. A plan B, leasing. You mean
let's say you're flipping houses.
Mm-hmm.
Let's say you're flipping houses, and this is just a very common example. That's why maybe your listeners don't do much of that. But if you're flipping houses, if you're flipping higher end houses, and some people do that, they get into the $500,000 house, and I'm going to make a couple $100,000 when I flip it, which is fine and well if the market is strong. But if you get caught holding some inventory, and you can't cash flow by leasing it as a plan B, if you can't sell it, then you could end up losing, and losing it all. And so, that's a plan B. A plan B would be, you're going to buy something and wholesale it or flip it or do something like that. But you should have a plan B if you're as a thought process. Think about what could happen if you can't sell it. And typically leasing is a good solution, but then you also have to think about the type of debt that you have on that property, the parameters for that debt. If you've got, a short-term hard equity loan, you better have a plan B for some other financing in case you got to be careful there, and that
financing dries up.
And financing could dry up. So you just just go in with both eyes wide open. Definitely invest, definitely be looking for deals, but just be thinking, what could happen if it pulls back, because sometimes it can pull back fairly quickly.
Sure, and let's talk about. Going back to 2008, you had your seminar and learned a pretty expensive lesson. Then you said, at some point you said, you know what, I'm going to focus on multifamily and apartments. How quickly did that happen?
It happened immediately because I had apartments that were doing okay. Mm-hmm. So, but I had to recover. Literally, I had to recover from what happened, and I ended up building a company, and I still have it. It's a litigation support company, and it's going fine, but it's not my love. My love is real estate. So I'm back in real estate, and I want to give back and teach people from my mistakes, not to make those mistakes. And that's why I started the podcast, and I just love it. I love the energy of it and talking to people that are experts in it. And I'm just really enjoying it.
Yeah, it's a lot of fun. I get a lot.
I'm sure you do too. Yeah,
I get a lot of great value out of listening to your podcast and
thank you.
Hosting my own. I know I've gotten a lot of great value out of the guests. I want to get back to the multifamily, because that's where you're focusing now, is multifamily, right. And it sounds like you're looking out of state as well. You're based in Sarasota, Florida?
Correct. Yeah, correct. No, I'm looking pretty much the eastern half of the United States, with a really hard focus on the 6 states that are near me, the eastern half of Tennessee, Alabama, Georgia, North and South Carolina. And because those are all drivable. So those are the heaviest look. But if we see something, north of us, north of there, we will look at it. Now, I wouldn't recommend that to anyone new, someone that's new in the business. I would say look in your backyard. There's always diamonds in your backyard, and there are lots of ways to try to get off-market deals in your backyard. Like we're for example, we're doing a mailing campaign. We're setting it up now, and we're going to mail property owners in our backyard, and it's a long-term thing for us. We want to start developing relationships with people that own property, even if they don't want to sell right now, and so that's being put together right now. And I'll tell you a little tip. I've always made the most money when I've been willing to do what other people aren't willing to do. And so one of the things we're doing with our mailing campaign is, a lot of these properties, multifamily properties, are owned in LLCs. And those LLCs typically have a registered agent. If you go to the tax assessor's office, you try to find a place to mail to try to get to the owner. What we're doing is we're actually going right to the Secretary of State to see who owns that LLC and capturing home addresses and phone numbers and names, so that we have a much more targeted mailing list. Now, it's a lot of work, but it's something that's like a long-term thing for us that, we do a few a week, but it's building a much better list. And so there's a suggestion for those of you listening that want to, do something in your own backyard. If you're willing to do what other people aren't, you may find that, you likely will find some golden nuggets, golden deals.
Now, is that information you find online, or do you actually have to drive
Sure.
to the Secretary of State?
No, you can do it online, but it requires someone to literally look that up and capture it somewhere on an Excel spreadsheet, or maybe some CRM software or something. We're using some CRM software, but that's just a little tip for again, some guerrilla marketing, and so that's what we're doing.
It's a great tip. Have you have you actually started your campaign, or are you just
we're actually just getting it going. I've got a full-time researcher, and he's putting it all together, and we may actually hire somebody out of the country to do the heavy lifting on it. We're looking at the Philippines to try to get somebody to actually do the heavy lifting. So there's another tip I guess gave you.
Hire a virtual assistant.
Absolutely, yeah. Mm-hmm. So. You can get those people pretty cheap sometimes. You have to manage them, though, I will tell you that. But, hey, again, do what other people aren't willing to do. We will likely actually do an outbound call campaign. So not just mailing them. We will actually likely call and say, hey, if you ever want to sell, think of us.
Okay. So once you get the information from the Secretary of State, you have the phone number, you can give them a call.
Yeah, sometimes they have the phone number there. Sometimes you have to look up the phone number on some other databases. but you can get a number maybe a fourth of the time, and it's silly not to call them. So that's what we plan to do.
Great. What about the properties you're looking at out of state? How are you finding those? Are you working with brokers, or are you doing direct mail campaigns?
There's so many websites. The best thing is to work with brokers, and I will tell you that. But there are a lot of websites, and of course, everything that you see on like LoopNet has been looked over pretty hard. But I interviewed a couple of guys on my podcast that found a dated deal on LoopNet, and it was just that nobody had seen it, and these guys literally bought it, owned it for 18 months, and refinanced it and pulled $1.7 million out of it. So
wow.
They're there. That's Jake and Gino if somebody wants to watch that or listen to it rather. But the deals are there. You just have to get out there and look. And even if a deal doesn't look like a good deal at its surface, like let's say it's a low cap rate, dig in. Maybe they've got expenses that are really out of whack, or maybe the rents are low, or combination of those two things. Don't be afraid to look at a deal that doesn't look great on the surface and dig into it. So that'd be another tip I'd give you, because you can find gems that way too.
Let's talk about the difference between single families and multifamily and apartments.
Right.
What are some other reasons that you are now going after apartments and multifamily?
Sure. Well, just from experience, okay, I talked about the challenges just with maintenance, okay, huge challenges because, there's so many different components in single-family houses that are going to be different between the houses. So, buying the parts and then the logistics of a maintenance man driving all over. And you have to remember, I was 2 hours in each direction. Even if you're just, have things in like a 30-minute geographical area, they have to drive to the property. They have to drive to Lowe's or Home Depot or the home goods supplier to get the parts and drive back. And all of that costs money. Whereas, in an apartment community, typically they're going to have the same types of appliances, the same types of HVAC, the same types of plumbing components, all copper or all PVC, similar electrical components. And it's just easy to stock things, and it greatly reduces your cost when you're fixing things up. So that's maintenance. Then on the leasing side, if you've got a leasing person and just from a effective time management standpoint, if they're driving all over to try to meet tenants at a property, the tenants don't show up. The prospective tenants don't show up. There's a lot of time wasted with travel time and showing where if you're working out of a complex, it's so much easier. It's just particularly if it's if it's something 50 units or more, because you can have on-site people helping with that. So, just from a logistical standpoint, it's much, much more advantageous to have multifamily versus single-family homes. That's just from my experience. Even the make-readies, when you're turning over a unit, they're all in one, in one building or one complex, and you've got a few vacancies. You can do them one at a time and show the one that's ready. It's much, much easier than with single-family homes. Well, I guess you could do the same thing with single-family homes, but just logistically so much easier to manage, lease, and maintain property when it's all in one location.
Yeah, I would agree with everything you just said. And I just received an email today from one of our maintenance guys at a 207 unit apartment complex that we own here. And he ended up buying 10 air conditioning units, all exactly the same, but he got a discount of $100 on each one because he was able to buy them in bulk.
Absolutely. And it's another great example. You can buy in bulk and stockpile this stuff. And if he's got them in a room there at your facility, it's so easy to switch one out. And you can use parts from different pieces of things as well and switch them out and save money that way. But one other thing I want to mention, and your listeners may or may not know, frankly, it's as easy and sometimes even easier to get financing on multifamily than it is on residential. So, why not go a little further and get a multifamily property if it's going to be the same amount of work to get the financing? And I will say this: if there are people listening that just want to get into this and are thinking multifamily, go out and buy a duplex or a fourplex or a triplex. You got to live in it, but if you buy one that you're willing to live in, you can get FHA financing, very low cost, very low down financing, and that's available up to a fourplex. So that's a great way to start. I interviewed one guy that did that, and he started out with a duplex, and now he's got 100 units. It took him 10 years, but he's got a significant portfolio that he did all with sweat equity, all of his own money, and that's how he started. So, there are ways to get into this business, and you don't have to buy a 100-unit complex. You can start small with plexes.
Yeah, I think there's no better way to get into investing than to buy a multifamily and live in one of the units. I mean, it just makes so much sense.
Right. Fix it up, and then move on to the next one.
Exactly. It's a great way to build a portfolio.
Right.
How are you coming up with the money to buy the properties as you are now looking at apartment deals out of state, around the east side of the country? Are you syndicating or
Sure.
What are you doing?
Yes. No, I'm syndicating, and it's funny. I originally started doing the podcast thinking that'd be a great way to connect with potential investors. And that's funny because honestly, I get so much pleasure out of it. I don't even care if that's a byproduct of it. I'm just getting such great feedback and meeting such great people. But you definitely have to syndicate if you're going to do larger, unless you've got a lot of money sitting around. But if you're going to buy larger properties, then you do a syndication, and that sounds very intimidating, but it's really not. You just have to have a good attorney that can draw up the documents, and for those of you who don't know what that means, you're just pooling money, and you're bringing in investors, and you're typically having someone get some financing, but you're typically bringing in investors for the 20 to 25% that you're going to need to put down, and these would be equity partners in the deal, and they could be equity or debt partners. They could treat it as a loan, but it's much easier to get people that are going to get a little piece of the upside as well. And there are lots of different ways you can structure it, and they can have a return plus a piece of the deal, or and that can vary depending upon how you want to structure it. But it's a great way to get other people involved. It's a great way. Multifamily is a great vehicle for this. It's a very safe vehicle for this, and people. There's a lot of people with money out there that are suffering and getting 1-2%, if that, with CDs, and the stock market is very volatile. So this is a secure way to offer people a much higher rate of return, and it's a win-win all the way around. And it's okay. I'd rather take half of a deal than 100% of no deal. So it's okay. I don't mind doing that.
Yeah, it's a great way to go. And anytime you have more than what is it? Any more than two investors, it's technically a syndication.
I'm not going to speak to the legalities of it because it's changing. In fact, it just changed this year again. The accredited investor requirements have been relaxed, and with crowdfunding and all these other things of getting investors. But I will tell you that anytime you offer a rate of return publicly, it's a syndication, and you can't do that. You have to have a relationship, and there's some rules. I would tell anybody that's interested in doing this that they need to, they need to find a good attorney that does syndications, that has done some, and sit down with them for an hour, and you'll know the basics, and they can help you with the paperwork.
Yeah, it's crucial to have a good attorney who knows what they're doing.
Right, and they'll coach you before you go out and talk to anybody besides friends and family. Make sure that you've spoken with an attorney and know the basics and understand what you can and can't do, and don't violate that, obviously.
Multifamily is your focus now, and the podcast. Let's talk a little bit about your podcast. And I know I started with this question.
Sure.
But lifetime cash flow.
Yeah,
let's
that's the thing.
That.
I met a guy, and the reason I came up with that name is I met an old Jewish man in Denver when I first started buying real estate. And he had all kinds of free and clear multifamily real estate. I was trying to buy one of them. I didn't end up able to buy one, but he sat me down and I said, I told him what I wanted to do, that I wanted to buy real estate and pay it off and just live off the income. And he said, son, I've done that my whole life. I've got all these free and clear properties. He said, if you want to do that, you will have buckets and buckets of money. And I said, I like the sound of that. And that actually has stuck with me. And we're talking, almost 40 years ago, 38 years ago. And that's how long it's stuck with me. So, what else can you buy that somebody else pays for? Nothing. And, you buy a apartment community or buy some multifamily property, put some tenants in it, and they are paying it off for you. And, and there's nothing stronger than free and clear real estate. So, you get a check every month. Those are, people out there that are flipping houses, every January 1st, they go back to work. Okay. If you buy and pay off real estate, that real estate can support you for your lifetime and your hair's lifetime. I interviewed like I said, that first interview that I did on my podcast was with a gentleman that's a billionaire that owns 35,000 apartment units. And, I've met a lot of gurus out there that say buy and sell, and, this is the right time to buy, this is the right time to sell. But I asked this guy, what's your strategy? And he said, I'm not a seller, I am a buyer. I buy and I hold, period. And I said, hallelujah, because that's exactly, that's what I thought I was doing with my single family homes in Florida, because that was my mindset. I'll just hold these forever. But, nobody expected the downturn to be what it was. And so it didn't work there. But had I been in multifamily, I would still be here and in fantastic shape. So, that really stuck with me too. There's nothing you can buy that somebody else pays for. And once that property is free and clear, it doesn't get any better than that. That's big income, and it's lifetime income. Obviously you've got to have good management. You've got to have somebody watching the place and keeping things up. But it's not a job at that point. You could hire it out if you wanted to, and that's big money. So that's why I get excited about it.
It is exciting. The idea of owning multifamily and everything you just said, having people pay for it and getting the cash flow from it and appreciation, especially if you do a cash out refi, that's all very compelling to.
Sure, you can, and that's tax. I'm not going to say tax free, but anytime you do a refi and pull money out, it's certainly tax deferred. And if you never sell, it's effectively tax free because you're never going to pay that tax. Like those guys I interviewed that pulled out $1.7 million, they didn't pay tax on that because it was borrowed money. And if they never sell that apartment complex, I don't believe there's a tax consequence. So, it's a don't quote me on that. I'm fairly certain I'm accurate, but it's still fantastic way if you buy right to get additional capital to buy more by refinancing, pulling money out. And the bank's not going to loan you the money if they don't feel the property is stable and can support it long term. So, you've got a kind of a barometer right there that you don't pull out too much money. But that's a great strategy. But again, buying this stuff, refinancing it, and then letting your tenants pay it off is a fantastic strategy. And you can also, by the way, when you buy, and let's say you buy with partners, you can structure your deal that when you refinance, your partners get paid out. They get maybe a preferred return, and then they get a little kicker when it's refinanced. Then they're out of the deal, and it can be your deal. So that's another way you can structure it so that once you refinance, they're out if the numbers make sense. So. Or leave them in. Doesn't matter. You can leave them in too. That's a great way to build a network of people that love you when you give them their money back and they're still in a deal.
Absolutely, and it really depends on what their needs are as well.
Sure, that's true.
I've done syndications where the investors have said we want to stay in as long as we can. We don't want to be cashed out, and that was fine. And then. Done other deals where it's a 5 or 10 year hold, and that's how long the investors want to be in. So
right, yeah.
Make sure they get out at that point.
No, that's right. That's a very good point. But what you want to do though for those 5 to 10 year investors, in my opinion, is you allow yourself the opportunity to get them out through a refi versus a sale, so you don't have to sell the asset. Because I can tell you, I really subscribe to that buy and hold strategy and building lifetime cash flow through holding it forever. I really do. If there's a way to pull it off.
Would you say there's ever a good time to sell?
If me personally, no, I won't. If I buy multifamily, I will. As I buy, I'm not a seller. I just like this gentleman Albert Perez said on when I interviewed him. He's not a seller. He's a buyer. Now you've got to buy assets that will have longevity. You can't buy stuff that's going to continually break down. You want to look at the structure. You want to look at the building. You want to look at something. If you're subscribing to what I'm saying here, to my strategy, you want assets that will survive for 30, 40, 50 years. So you want to look at that. But and you want to look at areas you don't want to buy in areas that are in decline. You want to buy in areas that are, and that's just common sense. You want to buy in markets that are growing. You want to buy in where the population is growing and there's job growth. And if you see in areas declining, I suppose that would be a reason to sell. Before it got too bad. But again, everything goes through cycles. I mean, look at Detroit. Detroit is coming back, and everybody, they tore down houses by the thousands up there. So, it's everything goes through cycles. And if you're willing to, if you're in right and the properties are cash flowing, you can survive a downturn. So, yeah, my mindset is as I continue to buy multifamily, I'm holding it onto it forever.
Great. That's a great mindset.
If you're thinking about getting into this space, just do it. Just like Nike says, just do it. Start studying it, start learning it, start, getting out there and looking at properties and enjoy it. I tell my son, don't, if you're going to get into anything, do what you love, and work is play. And I love what I'm doing, and associate pleasure with studying this and doing it, and it's play and it's fun. So that's the only thing I would say is the mindset around it.
Yeah, and mindset, by the way, that's something that you really address on your podcast, because every Friday you have a special episode where you talk about the mindset and the philosophy of achievement that you have.
The psychology.
Psychology.
I taught, anything, to be a success in anything is 80% psychology and 20% the mechanics. And so, I do have this something called the Driving Force Success Tips, and I talk about everything from goal setting to finding your why to visualization to manifesting to, habits to dealing with problems, dealing with fear, all those things. I really enjoy that. I've spent a lot of time working with Tony Robbins, and 16 years have been around his technology, and the guy's an absolute genius. And so you'd be an idiot not to have some of that stuff soak in, and that's the stuff I talk about. I appreciate you bringing that up.
Yeah. Do you have any books or reference materials that you would recommend?
Well, it's funny. That I recommend, absolutely. I mean, I would read anything from Tony Robbins. I actually also have really been enjoying Grant Cardone's stuff about influencing in sales. And, I could go on and on with books, but believe it or not, I'm actually writing one. And if your listeners want it, I'll give it to them for free. I'm writing one on multifamily cash flow and investing for cash flow. I think it's going to be titled Lifetime Cash Flow, but it won't be ready for 3 or 4 months. But I'm happy to give it to them for free if you want to. I can, I'll bring that up.
Oh, fantastic! Yeah. How would they access that?
They could text 41411 and just text my name, Rod, R-O-D, to 41411, and I'll put them on the list for it. And again, there's no upsell. It's just me trying to add value. It should really be a great resource for anybody wanting to get into this space, and maybe even people that are already in it, because it really breaks down how to find and do and manage and put together the deals. And I'm having a lot of fun writing it. But again, don't hold me to that time window. I'm pretty sure it'll be done then, but I'm happy to give it to them.
Oh, yeah. We'll look forward to reading that. I mean, it sounds
awesome.
Sounds great. If it contains, as many nuggets of wisdom and value that your podcast has, it's definitely worth a read.
Thank you.
So, Rod, thanks so much. I mean, and I would really recommend for listeners, I mean, if you're listening to this podcast, the Rental Property Owner and Real Estate Investor podcast, then you know the value that you can get out of podcasts. And especially if you're interested in real estate and creating that lifetime cash flow through real estate, then Rod's podcast is fantastic as well. So I highly recommend it. And Rod, thank you so much for taking the time to talk with us today.
Thanks, Brian. It's been a lot of fun. I really enjoyed it, and I appreciate the opportunity.
You've been listening to the Rental Property Owner and Real Estate Investor podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.